Welcome everyone to our discussion on the significant developments shaping the global economy. We are currently living in an era of profound volatility. The global economy is in its most fragile phase throughout its operational history, confronting an unprecedented degree of geopolitical instability. This situation has led to increasing global market uncertainty, akin to a powder keg on the verge of ignition. In this context, a prominent factor is the rising influence of central banks worldwide, led by the United States Federal Reserve, the Fed. The Fed, as the central bank of the world's largest economy, possesses the ability to move global financial markets. Every statement, every intention of the Fed chair can both create and shatter market trends, directly impacting stock prices and other assets. We can even liken the Fed chair to a high priest of the global financial market, whose pronouncements carry the weight of scripture. The Fed's immense power and dual mandate. The Fed's power stems from its exclusive ability to print and manage the US dollar, the world's primary reserve currency. This grants the Fed enormous power in controlling the money supply that every nation seeks to hold. But it doesn't stop there. The Fed's true strength lies in its capacity to influence the entire global economy through its monetary policies. When the Fed speaks, the global financial community listens. Since 1977, the U.S. Congress has tasked the Fed with a dual mandate. First, to maintain stable inflation, and second, to minimize the unemployment rate. However, this is an incredibly challenging task, as these two objectives are inherently contradictory. Achieving one often comes at the expense of the other. When inflation is low, it usually correlates with a sluggish economy. Businesses face difficulties, cut staff, or halt hiring, leading to rising unemployment. To stimulate the economy, the Fed typically lowers interest rates. Lower interest rates encourage individuals and businesses to borrow for consumption and investment, boosting spending, increasing income, reducing unemployment, and pushing inflation upward. Conversely, when inflation is high, the Fed will raise interest rates to cool down the economy, curb spending, and contain inflationary pressures. The Fed's independence. Theory versus reality. According to textbook theory, the Fed is granted complete independence from the government to make decisions deemed best for U.S. economic interests without external interference. However, reality is more complex. The Fed and the U.S. government consistently operate in a mutually supportive manner to advance specific economic policies. While the Fed has autonomy in its congressionally mandated duties, this level of independence is limited and always subject to a degree of governmental influence. This was most clearly demonstrated in how the Fed responded to the 2008-2009 global financial crisis. For an economy to grow stably, inflation must be controlled at a low and moderate level. Excessively high inflation poses significant risks, while excessively low inflation or deflation indicates a weak economy and a heightened risk of rising unemployment. The clash of ideologies. Free markets versus government intervention. See, in economics, two major schools of thought exist: free market policy and government intervention policy. The free market school, prominently championed by Milton Friedman, argues that government intervention often yields negative outcomes. The economy is a complex machine, and any deliberate attempts to alter the free functioning of the market can backfire, diminishing market efficiency in the long run. The best approach is to allow the market to self-regulate. Conversely, John Maynard Keynes, another renowned economist, advocated for timely government intervention to prevent crises from spreading and to mitigate severe economic consequences. Keynes believed that when markets operate efficiently, they should be left free. But when signs of a serious recession emerge, the government must act. Interestingly, the 2008-2009 financial crisis was the catalyst that compelled free market policies to give way to more robust government interventionist policies. Keynesian ideas have resurfaced with renewed vigor, signaling a shift in economic policy thinking. The Fed's market regulation tools. from interest rates to QE and forward guidance. Before the 2008-2009 crisis, interest rate control was the Fed's primary tool and proved quite effective. However, when the crisis struck, this tool largely lost its efficacy as the Fed was forced to lower interest rates to near 0% without successfully stimulating demand. Public fear at the time was simply too pervasive. In a desperate situation, the Fed was compelled to devise new tools to address the credit crunch. They innovated with instruments such as quantitative easing, QE, and forward guidance. Quantitative easing, QE. This involves the Fed creating a massive amount of money to purchase distressed bank assets and government bonds. The objective is to address liquidity issues and inject capital into the economy to rescue financial institutions facing solvency challenges. From an emergency measure, QE evolved into a frequently used tool by the Fed during crises. Forward guidance. This is how the Fed communicates its future policy intentions to the market. By leaking information or making clear statements, the Fed aims to enhance stability, reduce surprises, and ensure that the market reacts as anticipated. This builds confidence in the Fed's words and actions, which is critically important for global market stability, the consequences of cheap money and inequality. However, the Fed's policies of creating money out of thin air have left serious lingering effects. Cheap money became the new normal, but its true effectiveness remains a significant question mark. A notable consequence has been the inflation of asset values, real estate, equities. This directly enriched the elite who owned the most assets, as they were the first to access this new money. Meanwhile, the assetless working class was left behind, facing lower incomes and less job security. The wealth gap has widened dramatically, reaching record historical levels. The Fed relied on trickle-down economics, believing that enriching the wealthy would cause wealth to gradually trickle down to lower strata through increased spending and investment. However, market data has proven this theory ineffective in stimulating the real economy. The new money primarily circulated within the financial economy, failing to reach ordinary citizens to boost consumption. COVID-19, a new era and a profound lesson. The COVID-19 pandemic forced the Fed to adopt a completely new approach to QE. For the first time, new money was directly transferred to citizens' accounts through support packages. While this was a temporary measure, it demonstrated effectiveness in stimulating demand, something traditional QE struggled to achieve. The lesson learned is that if the ultimate goal is economic stimulus, the simplest approach, direct cash transfers to citizens, is far more effective than relying on complex, unproven economic theories. Currently, the era of cheap money has ended, and the era of high interest rates has opened a new chapter in the Fed's operational history. Fed is now grappling with the unintended consequences of its aggressive prior interventions, particularly surging inflation. To curb inflation, the Fed is compelled to take assertive actions which could indirectly lead to rising unemployment. Conclusion: the Fed's unending challenge. Managing the world's most powerful central bank has never been an easy task. The Fed has strived to rescue the economy through multiple crises, but the cost of these policies has been substantial, especially for the majority of the populace. Today's global economy enjoys wealth built upon a massive mountain of debt, raising questions about its sustainability. The Fed is once again adjusting to bring the economy back to equilibrium, confronting complex challenges created by its own past policies. It's an ongoing journey to ensure stability and growth for the U.S. economy and the world.